10-year Treasury yields are declining about 7.5 basis points today. Following a weaker than expected non-farm payroll report, the Nasdaq is up about 2% today. This data was definitely taken as good news for stocks. But there was definitely some bad news in all of this data as well, and that's what I want to highlight in this video. Because as badly as people want to see an economy that weakens, that at some point will not be good for markets either. And we have some historical precedents to go over that would suggest that maybe next month and the next month payroll reports are going to come in on the even lighter side. In fact, if you take a look at where the jobs were actually added in the economy last month, 87,000 of the total jobs were added in healthcare and social assistance. If you were to strip that out, this jobs report would have been under 100,000 jobs this month. Transportation and warehousing comes in at about 22,000, retail trade at 20,000, wholesale trade at 10,000, construction at 9,000, government at 8,000, manufacturing at 8,000, financial activities at 6,000, and leisure and hospitality at 5,000. Utilities added 0 jobs last month. Mining and lodging lost 3,000 jobs, professional and business services lost 4,000 jobs, and information was the biggest loser, losing 8,000 jobs last month. As CNBC says here, the slower job growth could be good news on the inflation front, but will raise concerns about a broader economic slowdown. Julia Pollack, chief economist at ZipRecruiter, said in a note on Friday, quote, "After what looked like a reacceleration in the first quarter, today's jobs report shows the labor market returning to its prior trend of gradually slowing job growth and wage growth. Instead of stagflation, the report shows solid payroll gains, 175,000, about 10,000 more than the 2019 monthly average, and cooling wage growth 3.9% year over year, down 0.2 percentage points. Exactly the news markets and the Fed were hoping for. The overall picture is one of a steady labor market with disinflationary growth," Pollack continued. I would like to remind you that back in 2019, there were a lot of fears of a recession coming. So to sit here and say we're a little bit better than 2019, but think back to 2019, if you guys were invested in the markets, there was a lot of conversation about a recession coming back in 2019. Now, as I mentioned, the unemployment rate ticked up from 3.8%. It was expected to stay the same. It went up to 3.9%. Markets are also taking that as good news today. But I will tell you definitively, average hourly earnings month over month came in at 0.2%. The expectation was 0.3%. That is really good news because wages, needing to pay your employees more, is an input cost that will lower margins unless you raise prices to offset that, in which most companies have been raising prices to offset the higher wages they have been paying their employees. Now, here's the logic to why I really don't think it's good news when the economy slows down, because I mean, sure, it's great if the Fed is able to cut rates, but it is a very fine line. In a perfect world, if the Fed could cut rates at exactly the moment where, let's say, non-farms hit like 120,000 a month, just right at that breaking point, the Fed can come in, start cutting rates. That would be fine. That would be great. That'd be dandy. But what tends to happen is non-farms, they tend to collapse when they start to fall, and if you are actually entering into some kind of recession. So if you take a look at this chart, this is non-farm payrolls each individual month. This is from 2000 through 2012. You had 2 recessions during this time, okay? I want you to pay attention to what happens right before you start to see negative jobs on a month-over-month basis. Back in February of 2001, you had 87,000 positive jobs, 87,000 job ads. And what happened the next month? You were negative 35,000, and then you were negative 300,000 the month after that. Okay, great. What happened before the great financial crisis? Well, you came in at 116,000 job ads, 105,000 job ads, then you fell to 1,000 job ads. Next month, you were negative 71,000 job ads. So within a month or two following a real slowdown, you tend to actually go negative on your jobs numbers. And again, with our markets, you don't want to see a bad economy because that means earnings, they're not going to come in as great. Stocks are priced for 10% earnings growth this year, 10% earnings growth next year with a very rich multiple. If you did start to go into a recession, or if that's what the market started to forecast, then you can cut the multiple down to 19, 18, something along those lines. You can cut the EPS estimates by 20-ish, $30 or so. That's problematic. That puts you back to, that would put you down like 20% on the markets at least. And that's in a kind of moderate recession or slight recession, if you will. Now, my base case is not for a recession, but I do realize it is a slippery slope between the markets begging for weaker economic data and actually going into recession. Preferably, you would want to see a strong economy, a strong labor market, but just inflation falling. It's like 2024, inflation has been rising, so we'll take what we can get. A weakening economy is a good sign inflation might come down, but it doesn't necessarily mean that. And in that scenario, the Fed would probably wait to start cutting rates if inflation continues to rise, even if the economy is starting to falter. So the bad news today was your ISM services PMI. Now, you can make the argument, again, whether non-farms coming in 60,000 jobs lower than expected was good or bad news. The unemployment rate going higher. Some people would say that's bad news. Some people would say that's good news. Who knows? I think it's probably in the middle. ISM services PMI, this was unequivocally bad news. Not the headline number. The headline number came in lower than expected at 49.4. The estimate was 51.8. ISM services business activity came in at 50.9. The estimate was 56.4. So business activity in the service sector definitely slowed down. ISM services employment continued to slow as well, now in contractionary territory at 45.9. The estimate was 48.6. ISM services new orders came in at 52.2, missing expectations for 53. But it's this. ISM services prices came in at 59.2. The estimate was 53.5, which was actually expected to rise a little bit from last month. Just was 1/10 of 1 point. It went up, not 1/10 of 1 point. It went up 6 points on a month-over-month basis. That's saying economic activity slowing down in the service sector. You can make an argument the labor market's slowing down based on this report that we just got today, but service prices are rising still. So that's not great. That's really a big reason why IWM did really well today. Was up to about 204 in pre-market, came down a little bit, popped up, came down, popped up, and then right at 10 o'clock in the morning, you sold off pretty aggressive. And then you've kind of just traded sideways, holding up a less than 1% gain today. If ISM service prices paid were to come in line with expectations or slightly lower than expectations today, I think the Russell would be up 3 to 4% today. But that did not happen. And if this trend continues, markets are going to be in a rough position. Let's be honest. If the economy continues to get worse, who knows, at a slow or fast pace, we can all speculate that. But inflation continues to rise and show, service sector inflation, manufacturing inflation is continuing to rise. We got ISM manufacturing data this week. Again, prices paid coming in higher than expectations there as well. That's not exactly the greatest scenario to be in. Now, ultimately, I think inflation will fall in towards the next couple of months throughout the rest of 2024. But if I am wrong, yeah, markets are probably not going too much higher from here. And it's important to keep in mind that really the most important thing to stocks is a recession, right? As far as downside, think about 2022. Stocks did very poorly, even though you didn't have a technical government defined recession. You had a technical recession of declining GDP in Q1, Q2 of 2022. Most of that was chalked up to inventories. But what happened? You hit the lows in October, November of 2022 as markets were dead set. At one point, Bloomberg was reporting a 100% chance of a recession in 2023. So stocks sold off, multiples went lower, EPS estimates went lower. And 2022 subsequently was a rough year. What happened in 2023 is the economy continued to do well and everyone was offsides. They were wrong. They were underpositioned for a good market. Now I see the risk as maybe we're overpositioned for stocks to do well, for the economy to do well. I think it's too early to make any definitive conclusions clearly what's coming next for the economy and whether or not recession fears come into the markets. Again, keep in mind, recession fears are what is going to drive stocks lower if indeed we start to, get worse economic data. But I think that's a risk we have to acknowledge in 2024. Now, I also want to be transparent with you. It's an election year. It's very bad politically if you go into a recession during an election year. You've only seen one president that has ever won a re-election during a recession, and that was William Taft back in 1913. So, I mean, your odds of winning the presidency are not great if the economy is in a recession. And by the way, 6 presidents have ran for re-election during a recession, and none of them, besides William Taft, have actually succeeded. I think it's highly incentivized to keep the U.S. out of a recession, and I think long before a recession actually comes, the Fed's going to be cutting rates big time. Now, if we get another bad non-farm report and maybe one inflation report that comes in lower than expected from here, I think the Fed's going to be cutting rates pretty quickly, assuming the next month's non-farms are going to come in weaker, and assuming next month's inflation report comes in weaker, you could be looking at rate cuts as soon as July. Specifically, that would be July 31st. Now, it's possible you could get some rate cuts in June. You will get another inflation report right before the Fed does meet, as well as another non-farm payroll report before the Fed meets 5 weeks, 4 days, 22 hours, and 19 minutes from now. I love how specific they get, but the next meeting is on June 12th, 2024. Now, based on the data today, the markets are now forecasting 2 rate cuts in 2024. So you went from pricing in only 1 rate cut in December to now 2 rate cuts. So you're pricing in the first cut September 18th, 2024, and the next cut in December of 2024, December 18th, 2024. Now, again, if the economy weakens further from here or inflation falls further from here, you're going to be getting that rate cut pushed up to July, which would be, it goes July and then it goes September. So if you don't get a rate cut in July, then August, well, there's not even a meeting in August, so that's off the table. So I would bet, if I had to put my money on it, we probably get the first cut in July. Now, the markets will start to kind of price that in upon the next couple data releases that we get. In that case, I do think the area of the markets that will by far benefit the most are the small caps, okay? If you start to get a Fed that is about to start cutting rates, you're still 20% off of all-time highs for small caps. And you've seen an earnings recession in 2022. That's why that's another reason why stocks did poorly. And the Russell as well. But the Russell has not really come out of that earnings recession yet, as per a lot of your analysts and big money interpretations on Wall Street. This earnings season is still far from over, especially for the small cap stocks. Next week's going to be another big week for small caps. And I think, again, if you wanted to be bullish on an area of the markets, it's not the NASDAQ sitting at basically all-time highs. It's the Russell that's still down 20% from all-time highs, in which will benefit by far the most when you start to get rate cuts from the Fed, maybe as early as July. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.